You're watching episode 40 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall, and before we get started, I invite you to join our Tax Smart Facebook group and our Tax Smart newsletter. Links to both of those are in the description of this video. Today's topic is about a question that came out of the Facebook group actually very recently, about an hour ago. The question is, can I qualify as a real estate professional if I only have out-of-state rentals? Now, before we jump into the actual question, let's talk about what a real estate professional is. We talked about real estate professional status on episode 1 of the Tax Smart Daily, so if this is not as comprehensive as you would otherwise like, go check out that episode as well. To qualify as a real estate professional, you have to spend 750 hours in a real property trade or business. You also have to spend more time in real property trades or businesses than you do in any other activity. So those are the two tests to qualify as a real estate professional. That second test, spend more time in real estate than anywhere else, typically kicks out people with W-2 jobs, especially if you have a full-time W-2 job. If I work 2,000 hours on my full-time W-2 job, it's going to be really tough to justify that I spent an additional 2,001 hours working in my real property trader business. I spent 4,000 total hours. That's going to be hard to justify to any sort of auditor, and especially to the tax court. The 750 hour test is pretty straightforward, but you do have to have that 750 hours is time actually spent managing the activity, in the activity, working on the activity. You know, we see other advisors saying you only have to spend 500 hours of material participation and then 250 hours of anything else. It's just not true. All 750 hours have to be material participation hours for the purposes of the real estate professional status test. Now, I'm not going to jump into what hours count and what hours don't count. Again, we talked about that on episode 1, but I am going to re-emphasize the importance of qualifying as a real estate professional. If you qualify as a real estate professional, your rental losses will be non-passive. That means that I can buy a duplex or a quadplex or a 15-unit or a 30 or a 50 or 100-unit apartment complex. I can cost segregate it. I can accelerate depreciation via bonus depreciation. That's going to create a big tax loss in year 1, and then I can use that tax loss to offset my other income, whether it be W-2 income, my spouse's W-2 income, business income, gain on Apple stock, whatever other income I have. So that's the benefit of qualifying as a real estate professional, to be able to use the rental losses to offset all of my other income. But again, to qualify as a real estate professional, you have to spend 750 hours in a real property trader business and more time in real estate than you do anywhere else. So how do you do that with out-of-state rentals? Well, it's going to be really tough to do. The reason it's going to be tough to do is with out-of-state rentals, you typically have a property manager. And if you think about it, the property manager is the real estate professional. They're the ones that are managing your property on a day-to-day basis, not you. And some people say, well, managing the property manager counts as time towards real estate professional status. It typically does not. That's an investor level activity, and investor level hours only count if you're involved in the day-to-day management of the operation. I guarantee you, if those rentals are out of state, then you are not involved in the day-to-day operation of that rental activity. So most of those out-of-state rentals, they're probably not going to be included in your hours to qualify as a real estate professional. Now, if you have a larger portfolio of out-of-state rentals, it might be a little bit different. You know, your facts and circumstances might actually point to the fact that it is a significant part of your day and that you should be a real estate professional, even though they're all out of state, but the portfolio is really large. It's a big part of your day. So that's the difference. I wouldn't expect to buy 1 or 2 out-of-state rentals and think that you're going to be able to log all these real estate professional status hours. It's just not going to count. And again, managing the property manager, not going to count unless we're talking about large deals, large portfolios, bigger deals, bigger portfolios, lots more management. That's where that managing the property manager time might start to count, but it is dependent on your facts and circumstances. So if you're listening to this video and you're going, what a bummer, my suggestion to you would be to continue investing out of state. I think it's great that you're not limiting yourself geographically, but think about how you can get all of your out of state rentals to qualify as non-passive. One strategy that you might be able to deploy is to buy something local to you, rehab it, self-manage it. So rehab it, rent it out, self-manage it. You might be able to hit enough hours operating that rental property where not only you can qualify as a real estate professional, but maybe you hit that 500-hour test for material participation and you can make the 9 election, 469-9G, to group all of your rental activities together as one. And because you've already hit the material participation tests on this one rental, again, material participation is different than real estate professional. So we hit real estate professional, but we also hit that 500-hour material participation test. Because we materially participated, we can make that 9 election, group all of our out-of-state rentals into our local one. All of our rentals are now treated as one activity, and now all of our rentals, including the out-of-state rentals, are non-passive for the purposes of Section 469. Thanks so much for watching today's episode of the Tax Smart Daily. Hit us up in the comments below if you've got any questions or if anything that I say resonates with you. And then we've got a whole bunch of links below, so check those out. Follow us online. Join our new premium content platform. We'd love to have you. That's taxsmartinvestors.com.